Hey guys, great to be here. So we're just going to delve right in. So what is DeFi? DeFi has mostly gotten popular within the last year or maybe the last 2 years, but probably the vast majority of it in the last 12 months. Crypto has been around for over 10 years, but DeFi is really this kind of new phenomenon. It's actually a phenomenon that has been sort of tried and attempted since the beginning of crypto. So the very first Bitcoin client had a decentralized, or an attempt to make a decentralized poker game in it. And that was kind of Satoshi's attempt to create some type of DeFi. It didn't work out, it was removed from the client. But ever since then, there's been this idea that we can create decentralized games, decentralized financial applications, decentralized trading systems. And for most of crypto's history, it's been this sort of pipe dream that people have thought about but hasn't been actually possible. So the really incredible thing is that the last year, maybe it was some technological breakthroughs, but I think also just as much as technological, it's been sort of a social and financial engineering breakthroughs have happened, and just momentum and groundswell has happened, and DeFi has really taken off. So, so this is the interface of Sushi, one of the most popular DeFi interfaces. So basically, Sushi is a pretty typical example of a DeFi application or a DApp. It's a way to trade, borrow, and lend, all via this interface. And the difference between this and, say, a Binance or a CoinFLEX is that instead of trading with a centralized exchange, you're actually trading with a smart contract directly out of your wallet. There's no KYC process, so it removes the barriers, and the interface is great. But the biggest thing is you're trading in a completely decentralized way. So you're trading not with a company, you're trading with a decentralized smart contract. Basically, smart contracts are, if you think about a legal contract, you're agreeing, if I give you $1, you give me something else, or if I do this for you, you do that for me. This relies on people being afraid of the law enforcement, and people being afraid of being sued or having some sort of risk, and people just doing what they say they're going to do. Now, the problem with this, obviously, is sometimes the cost of enforcement is very high. So let's say I'm doing business, and I'm in Hong Kong, someone else is in Australia. They renege on a $10,000 contract. Let's say I'm buying wines from Australia. They renege on a $10,000 contract. It might cost more than $10,000 to sue this company or this person. So I would never actually sue them, and I could, damage their reputation online, but, basically I'm never getting my $10,000 back. So the basic concept of smart contracts emerged from people who were frustrated with the unenforceability of legal contracts, especially small-size legal contracts, cross-border legal contracts, and basically, generally, if you're a large corporate, multinational corporation, you might have a high ability to spend money on lawyers, but if you're a random person, you might not be able to do that. So smart contracts emerged as a way to guarantee that if this, then that, and rather than rely on the goodwill of the human you're dealing with, you program in the interaction, let's say it's a trade, in such a way that if I give you this, you will necessarily give me that. And there is no even possibility for a reneging. There's no possibility for a default, effectively. And the second part of this is probably just as powerful and extremely simplistic, and has actually been an important part of Bitcoin's history since probably 3 years into the creation of Bitcoin. So this is called a multi-signature contract. And so this is we can understand this very simply, where if I create a Bitcoin address or an Ethereum address, and I set up the rules such that me and 2 other people have to sign off on this on any outgoing transactions. So at least 2 out of 3 of us have to sign off. And what this does is allows for funds to be pooled together, in such a way that you know that one person can't run away with the funds. And this started taking off in crypto exchanges early on when they had to have individuals at the end of the day holding the keys. They made it such that many teams were holding the keys. My last exchange, I think, was the first company in the crypto space to use multi-signature in a corporate commercial sense. And then DAOs are based, and so that was a very, very simple one, but it comes into play in DeFi in a big way, and we can get into that later on. DAOs are a very powerful concept. The idea, the term DAO stands for Decentralized Autonomous Organization. So the idea, and it kind of comes from sci-fi, is that instead of a company, you have this artificial intelligence entity that has a mission and just executes trades, executes things, pays people to do stuff in pursuit of that mission. So this is sort of, it's a sci-fi idea. Crypto has, at most times the last 10 years, kind of attempted to get towards this. And so most DAOs are not actually fully decentralized. They may not even be fully organizations, but even in the state they're in now, they are an alternative to the legal structure of a corporate entity. So when you have a company, you have a physical location that is incorporated, let's say Hong Kong, you have to pay filing costs and setup fees. Here, obviously, they're very, very cheap to file and set up companies. But at the end of the day, there is a physical jurisdiction it's based in, which has obviously disadvantages and advantages. And there are people that are involved in it. The power of a DAO, or the power of crypto's instantiation of this concept, is that you can have, rather than people, you can replace it with tokens. So what you have in crypto is this concept of a governance token, where rather than me being the CEO and I have a bunch of employees and shareholders and a board, it's the token holders actually control the application itself. And so in a very basic smart contract, you can have, I'm trading with this person. But then there are questions that emerge, like, is there a trading fee? Should it be turned off? Should it be turned on? What do you do with the fees? Do you use them for some other purpose? Do you hire developers with them? And so what DeFi has created is this concept of an organization that doesn't exist in any legal structure. It's effectively apolitical or ajurisdictional, which and we'll see how regulators react to this, but is a way effectively to bypass regulation. Some of these even, Sushi, for example, is one of them. Some of these have anonymous founders, or founders that have pseudonyms behind them rather than real names. And so this starts to become very interesting because, for example, the question of where is Sushi based? Well, it's really based on the internet. We don't even know where the founders are. We know a number of people that are involved in it as token holders, but theoretically, their liability should be limited to shareholder liability. Like passive shareholders in a business don't have any sort of liability if the business commits a crime or does something that's a regulated activity. Only the management do. Who are the management of Sushi? You could almost argue it's the token holders themselves. So it all of a sudden becomes this thing where decision-making gets spread to the actual token holders of, and this is what we call governance tokens, but the token holders of the application itself. And then once you can have that, you can have a whole new range of decentralized decision-making. Right now you have public companies with shares, people vote on things, but at the end of the day, hardly are there actually that many votes, and a lot of the shares are often held by, these kind of index funds. Here you have people that take the tokens, stake them in secondary things, and do all sorts of activities with them. It creates much more of a close-knit community around some sort of shared goal, and it creates that without any sort of local or physical boundaries or borders. So now we'll get into like some of the use cases and purposes of liquidity. So a purpose of DeFi. So the biggest thing, it's like, okay, all this stuff is great. It's decentralized. People are coming together. There's a community performance. What can you actually do? So at the end of the day, there's three main things that are happening right now. And there's a lot of other things. There's a lot of different apps and different projects that get launched. They're all kind of boiled down into these three main activities so far: trading, lending, and this secondary concept we're going to call yield farming. So basically, the creating here, Uniswap pioneered this, SushiSwap added to it, and a lot of other companies have created different versions of it. CoinFLEX actually created a version as well. Is this concept of an automated market maker. And this is effectively a automated trading bot that will provide liquidity to the public on the blockchain. So rather than going to an exchange or a company like mine or Binance or something like that, you're getting liquidity on the blockchain. So you trade ETH, you get USDC. And that trade is atomic, as in the moment you give the Ethereum, you get USDC. So it's not, the settlement is instant, and you don't have to sign up anywhere. You can just connect your wallet into their app and do this trade. Now, the interesting thing is, who are you trading with? So instead of trading with a singular market maker or a high-frequency trading firm or another seller, you're actually trading with what's called an automated market maker. So this is someone who said, I'm willing to put in some, let's say some USDC, some dollars, and some Ethereum, and on the way up, I'll be selling out Ethereum. On the way down, I'll be buying more. And if it goes up and down and up and down, I'll be collecting a bunch of money from those variations in price. So this is effectively a way to make money when markets go range bound. And obviously, if it goes up very high, you're effectively selling out of your position. And there's a number of really powerful things about this. But the most powerful thing is, if you think about traditional markets, they have very few market makers. This effectively lets anyone be a market maker. More important than that, it lets anyone list any asset. So before all this came into being, in order to get a project listed, in order to get a project to have liquidity, you needed to plead and beg and pull favors with some big exchange. And then maybe your project gets listed if you pay them a bunch of money. And these were the perks of being a centralized exchange. You can look at a sea of projects that all want to be on your venue and have liquidity because you're the source of that liquidity, and you can just choose the ones that will pay you the most money. And maybe you choose the most legitimate ones, or maybe you just choose the ones that you're friends with, basically. So who knows how fair that selection process actually was. This creates a really powerful alternative to that. The other problem with that is, usually by the time the projects get listed, a lot of the value has been captured. So let's say there's this project that's being built, it has some level of fundamental value, and that value is realized by traders. Oftentimes, by the time the project gets listed on some exchange, most of that value has been captured in a number of private transaction rounds. And that's the kind of financial exclusion that crypto is really here to kill. And so what Uniswap and what all these decentralized exchanges did is they said, well, we'll have no listing rules. Anything can list, and there's no permission needed. You can list your project instantly. You don't even have to talk to us. So you have to put up a pair. And this enabled for loads of coins to all flood into these markets. Lots of coins got created. It became easier to create tokens and create projects. And at the end of the day, it's a free market. It's a totally unfettered market. So a lot of these coins are scams. But you can't have groundbreaking innovation without also some crap mixed in. And so it really opens the playing field for new projects to get listed, and also opened the playing field for people to provide liquidity, and it also opened the playing field for people to trade. So all of a sudden, you didn't have to be some high net worth investor that had access to these founders and could give them money in their private deals. You could just go on Uniswap, find some token that just got listed and buy it. So, oh yeah, sorry. So lending is the secondary activity, and the powerful thing about crypto, if you think about traditional finance, a lot of the lending they do is like credit card loans or some type of corporate debt or small business debt. When you're doing that kind of lending, you are basically hoping that the other person pays you back. So you are making a bet and saying, this person or this business or this large corporate, good for the money. I'll charge an interest rate. This will factor in the risks that they go bust, and hopefully I get my money back. It's an educated guess. You're making a guess that they, end up giving you the money back. And that's how most lending business works. There's also collateralized lending, and in traditional finance, the collateralized lending market is an enormous market. You can call it the repo market, you can call it a lot of different things, but it's a huge market. The rates are really low because collateralized lending is very low risk. When you take collateral, when you take could be a house, could be treasuries, could be some sort of stock. When you take collateral and you lend, typically the rates are sub 1% or sub several percent with some sort of risky collateral. The cool thing about crypto is there's so much demand for capital, there's so much demand to borrow, that the collateralized rates are very high. So we have a product, it does collateralized lending, it invests in our repo market, it's called CoinFLEX EUSD. It's paying between 10 and 15% right now. There's Sushi has lending markets, a number of these kinds of venues have lending markets, and they're often paying, way higher than traditional markets. And so, and the cool thing is, there isn't additional risk. The reason why these rates are so high is because the Fed and traditional banks, aren't plugged into DeFi. So basically, the advantage that users of DeFi have is that they are getting into a market before the biggest players in traditional finance get into that market. And maybe they never did. If they never did, then it's just a gift. But there's huge demand for capital, not a lot of supply, and the powerful thing about them is that they open up the ability to supply capital to anyone in the world. So if you have dollars, you can mint them into USDC, and you can take them on these platforms, and people will borrow them from you in a way where they're paying more. They're paying 150% or 120% or 200% in crypto to be able to borrow those dollars. And so even if the crypto market moves down, they're going to be remargined in real time. And what that means is, they might get liquidated and you might get their collateral and then the smart contract will sell it and get back the dollars. But the end game is, because the collateral is tradable 24/7, it's effectively safe. So during your loan, there's no worry that the borrower repays you. If they don't repay you, the crypto gets sold and you get repaid. So it's a very low risk form of lending. It's only now possible because of DeFi. And one of the most powerful things, there are two powerful things about this, maybe three. One is access. The other one is the fact that it's 24/7 tradable collateral. The third portion of this, trading, lending, and yield farming, the third portion of this is kind of interesting, which is, if you think about any kind of new company or new project, they'll usually give sign-up bonuses or some type of commission or some type of incentive to sign up. And so you might see some fintech app and they have a $50 Hong Kong to sign up. That's pretty cool. But let's say you were the first person to sign up to buy an Apple iPhone 10 years ago, or not 10 years ago, or whenever the iPhone was invented. If they gave you a piece of Apple at the same time as you buying the first iPhone, you'd be hugely wealthy at this point. And this is effectively what these DeFi companies are doing with the concept of yield farming. So what they'll do is they'll say, okay, you can trade on our platform, you can find liquidity on our platform, you can borrow on our platform, or you can lend on our platform, right? Those are the four things you can do with just the act of trading and lending. Being one side or the other side of both of those two-sided markets, right? And they'll say, if you do these things, we will give you our governance token. We'll give you one of them for every hour that you trade, borrow, lend, provide liquidity, whatever the act is, right? And this is very interesting because instead of getting 50 Hong Kong dollars for signing up, you're actually getting paid in the token, which if the app becomes really, really successful, will be hugely valuable. If the app becomes, totally fails, then those tokens are worthless. So it's created this really interesting phenomenon where people start using the products just to get the governance tokens, and then they have a choice. Because if they're only doing it for the governance tokens, if they're only doing it for the tokens, they're effectively, they're what we call yield farming, but they're basically going to dump the tokens. So they do the activity, they do the trade, they get the tokens, and then they sell them, and then the project slowly fades to obscurity. And that's how a lot of these projects have gone. It's free market, right? It's complete open border. So a lot of these products have failed. But the interesting thing is some of them have gone on to become huge successes. And the people that own the most of the token are also the early users. So there's a very strong alignment between the community that holds the token and the actual users that understand the products best, because they're effectively the same people. So that's kind of, these are the basic, most common use cases of DeFi. I'm not saying these are all the use cases of DeFi, but I'm just saying when you boil down every major DeFi app in the top 10, it's usually some variation of this. So we know what's powerful about it. What are the risks? What are the dangers? Well, one problem is because you're not trusting, when you trust your money in the hand of a human, you have the risk that the human runs away with the money. When you trust the money with the hands of an algorithm, you have the risk that the algorithm has been programmed with some sort of flaw or bug such that it doesn't do what it says it does. And maybe if the programmer is novice and the project is small, it even advertised it would do this, and instead it had a bug that the programmer knew about, and he's just doing this whole thing to steal your money. So that's effectively the risk. That's one of the top risks. That's the biggest risk of DeFi. And the best way, the lazy hands, easy way to mitigate this risk is just to look at what projects have the most assets in them. If it's got hundreds of millions or billions of dollars in it, and what's been around for a long time. Again, DeFi is young, so anything more than 6 months is pretty good. But if it's been around for a long time, has lots of assets in it, that's a pretty good sign. There's now a whole cottage industry of auditors that audit smart contracts. And white hat hackers, which are like good guy hackers that fix these things. And so something that's been around for a while has probably been addressed. Bugs have probably been addressed by the white hats. And if they list the audits on their website, or if you can find somewhere where you can see, okay, these have been audited by several different teams, several different companies, these are all good signs. So that's one of the biggest dangers. The other danger is obviously if you are getting paid in governance token, or if you're buying a governance token and just the project suddenly becomes unpopular, or there's high amount of inflation, that can go to zero. And the way to figure that out is you look at the fundamentals of the thing. You look at whether this is a really useful, novel way to trade, borrow, and lend, or maybe it's just a me too that's trying to do what everyone else already does and it doesn't have any fundamental advantage. So the easiest way is to look at the size, and if you want to go further, you can look at the audits and all the fundamentals involved. And the other risk is obviously anyone who's using an automated market maker. You make money when the market goes up, you make maybe less than you would have just holding the token itself. You make a lot of money when it's range bound, and when it just crashes, it's the same. It's effectively similar to holding the token itself. And so Obviously, anytime you're providing liquidity in anything, but especially these automated market type way, you are risking, the capital involved in that trade. And so basically what DeFi solve really is a problem around accessibility, a problem around trust, people in different parts of the world not being able to trust each other. It created yield opportunities and rewards, and it basically created freedom. Yeah, so trust, accessibility, yield for lots of people who were interested in risking their capital. Not everyone wants to just hold money in a bank and earn very little on it and get it inflated away by central banks. And a lot of people want to make yield. And so there's different people with different risk tolerances. What DeFi does is give people the ability to pick the risk tolerance they want and earn the type of yield and reward and profit on the money they want. So ultimately it's financial freedom. If you want to launch a project, boom, here you go. If you want to lend out your money, go ahead. There's all sorts of things that you can do in DeFi that are very difficult to do in the traditional banking system, even just because it's not automated. Everything requires a person clicking a button and initiating a transaction. There is no way to program your money within the banking system. So that's really the power of DeFi, and it's programmable money that has no restrictions, no borders, and can be accessed anywhere in the world by anyone in the world. If we think about the access problem, it's a huge problem. It's effectively one where most people, there's lots of people that are banked, but even if you just look at the bank people, I think everyone in this room probably has a bank account, but people can't do complex financing. So if you think about someone with a bank account and they want to do some type of structured product or some type of over-collateralized loan where they're effectively acting as a finance person, crypto allows you to do all the things that a financial professional would do on behalf of their bank or their hedge fund as an individual on behalf of your personal bank. And this is like a level of financial empowerment that goes way beyond just giving people, let's say these unbanked people, the ability to make simple payments. This is like, I want to take total control of my financial future and present and past, and I want to, become a nation state, but I want to become like a bank level actor, using my wallet. That's effectively what DeFi does. It's financial freedom on steroids. So yeah, that's our presentation. With DeFi, we can take it in any number of directions. So in this one, I wanted to keep as much of it as possible for questions.
Thank you very much, Mark, for your insightful sharing on DeFi. So round of applause to Mark.
Guys, so we really do want to make this very interactive chat. Okay. We do want to make it very interactive. And so it's really important you guys keep posting up here. As we see questions come up, we're going to make it a dialogue between all of us here. But the most important thing with these questions, the quality of questions, are going to engage the quality of discussion. So trying to be very interactive with us, leading to we're trying to follow them through these. So, let's go back to the foundation of DeFi. You did a really great presentation. For a lot of us here, DeFi is a brand new topic. So when you go back to the foundations, DeFi is really getting yield on steroids. So we talk about risks, talk about foundations and all. We kind of see the DeFi market, the core sort of functions of it in lending going over the next 6 months between now and the end of the year. How do you kind of see the DeFi market globally evolving?
I think what's happening is you're seeing the ability to use a lot of these things together. So you might have lending and trading get combined into forms of leverage trading. That's something that Sushi at least is very interested in. You see the fabric of liquidity provisioning being an LP, being an automated market maker changing as well. Uniswap V3 basically changed the nature of how people provide liquidity from this kind of very simple formula to something where they get their own price ranges and and provide more concentrated liquidity. I think that's probably going to increase. There will be other formulas, other ways to provide liquidity that might even look different to either of those two models. And then I think a lot of this gets really, really interesting when it becomes what's called composable. So when you can take the liquidity you provide in DeFi and then go and take it to a borrowing and lending app and then borrow against that liquidity. This has been an idea that has been talked about for a long time within Ethereum circles, and it's never actually been done yet. So it kind of reminds me of those days, basically 2016 to 2020, when people would talk a lot about this idea of decentralized trading and DEXs. And there were some attempts in those days. There were some DEXs, but they were all garbage, and they were all very inconvenient. They didn't really work well. They were super slow, and they had a whole host of problems. And the fact that they had so many problems made most of us think it was never going to happen. I've always been a crypto guy, but I was even probably one of the ones that was like pretty skeptical of the idea of the decentralized trading industry.
Speaking of skeptics, Anonymous will stay anonymous for obvious reasons. It's just asked, why is the world so interested in unnecessary borrowing? Have we not learned any lesson? It does sound in some use cases that you're bringing up, and with all the excess of money supply it's floating around the global economy, has every project really need funding? Does every project really need this sort of application? So how do you kind of think about that question when a project is a real use case, or even when it creates, back in the day in 2008, moral hazard?
Well, there's a lot of people who kind of take this stance of, borrowing is dangerous. We should only do things that we can afford effectively. We should only buy with cash that you have. But I mean, the basic concept of borrowing is important for the whole economy to work. It's what lubricates the world. It is literally what powers even anything from as simple as a credit card to a mortgage, to something more complex, such as being able to sell a token you don't own. And some people hate that because they get shorted, but at the same time, what if something's overvalued? So the reason for needing borrowing, the reason for needing lending markets is because on one hand, you have people that are not doing anything with their asset, and they want to earn more of a return than just holding the asset. And then on the other hand, you have lots of people who basically, they might be very interested in still holding an asset, but they want dollars to finance some purchase that they have in the interim. And if you just think about it, if markets had no borrowing, crypto or traditional markets, they would be much more volatile, because every time a holder of a stock or a holder of a house or a holder of anything needed some cash, they'd have to sell the whole asset or some partial fraction of the asset, get the cash, and then maybe they'd be able to buy it back again later on. But that's two jagged, violent transactions. And if you just stick the asset somewhere, borrow against it, and then repay, those trades never happen. And where do you draw the line then, Mark, on things that don't really need to be funded, right? I totally understand the value of the global economy, right, versus mortgage to pretty exciting and innovative crypto projects can actually push things like the social sector forward, or energy forward, or lending forward for the right things. But do you feel like there's going to be an essence of moral hazard when there's too much cheap money and too much cheap lending, and you also suffer from counterparty exposure because the whole thing is on the internet? Who are you going to blame when things go wrong? I think the powerful, there's three forces that sort of act as a counterbalancer against the moral hazards of borrowing. One is by far the biggest, which is just the interest rate. So if borrowing is out of control, interest rates go up. In crypto, at one point in April and May, the interest rates to borrow dollars collateralized by crypto were very commonly 100% annualized. And it's pretty easy to see like, oh, maybe there's a bubble. Maybe 60K is not sustainable because it's largely funded by leverage. And so there was a collapse. That was a correction in the crypto price. And right now, interest rates are extremely low. Maybe that tells us something else. A lot of leverage has been wiped out. So I think interest rates are by far the biggest dominant force. And the amazingly powerful thing about crypto versus traditional finance is in traditional finance, interest rates are centrally controlled by the government, by the central bank. They're obviously they're allowed to float in some parts, but the base rate, which all other rates are based off of, are controlled by some banks, primarily the Federal Reserve in the U.S. And the thing about crypto is there's no centrally controlled rates, so rates float with the market. I can negotiate something with you, and someone else can negotiate something else bilaterally, and then platforms, and then exchanges, and then DeFi, and lots of different rates exist, at lots of different interest rates, and effectively it's a free market. And so that allows for, in times of high demand, rates get really high, and in times like right now, rates go back really low. The second thing is the demand for collateral. So if you want to borrow in crypto, you usually put up more collateral on the other asset. And say you want to borrow a dollar, you have to put up more Bitcoin than a dollar to borrow. So that is a natural curve on how much you can borrow, because if you think about it, in traditional finance, you often have large amounts of uncollateralized lending and also large amounts of extremely highly levered lending. So people think crypto is highly levered because it's 100x. Arthur Hayes, the founder of BitMEX, did a pretty good paper about how the central banks are typically 100 to 800x leverage right now. And so the leverage overall in crypto is very low, and the collateral is usually demanded at 110, 150%, even 200% collateral ratio depending on the asset. So those are the two biggest things. The third one is just the fact that the user, the borrower, has the risk of losing their collateral. And so they have the risk of getting liquidated, they have these kinds of risks. And they also have the risk of interest rates going up. If they pay a high rate, it's fixed, they have that risk, they can't pay that rate. So the fact that you as a user have to deal with the consequences of your actions, the fact that lenders have to deal with the consequences of the risk mitigates, the fact that this is all self-contained and there's no government that's backstopping or bailing people out is really what keeps it relatively mature and responsible. I want to change gears a little bit. So Henry asks, Ethereum versus Binance smart playing. The sector is growing quite a lot, and has some downsides, like some degree of centralization. Where do you see the degree of centralization going? So this is a great question. So Binance Smart Chain noticed something that was really important observation, which was that Ethereum had created all these network effects, but some of them were the fact that these apps all existed on the Ethereum blockchain. Some of the network effect actually had nothing to do with the apps and the assets on the blockchain, and had more to do with the fact that all of the code behind the apps was written in a language called Solidity. And all of the code was compatible with something called the Ethereum virtual machine, which was the compute layer that basically processes Ethereum smart contracts, Ethereum applications, and guarantees these transactions, as we talked about earlier. I give this, you give that. And that type of mechanical guarantee is EVM, Ethereum virtual machine. And so Binance created a new blockchain that basically mimicked the Ethereum virtual machine, but stripped out the fact that it was on the Ethereum network. So they created their own network using the fact that they were a large exchange, and they created effectively a network that was fully decentralized. It was run by 21 validators who were handpicked by Binance. There was no way to become a validator. And theoretically, they may all be Binance for practical purposes, or they might be random people that are friendly to Binance. But this is why people say there's a big downside to Binance Smart Chain, because it's all controlled by Binance, possibly. But it piggybacks off of Ethereum virtual machine. So anyone who is running an app on Ethereum could take that app and just replicate it on Binance. And since these apps were all mostly open source applications, anyone that didn't even invent one of these apps could just clone it onto Binance Smart Chain. And so you saw lots of clones happening, lots of code being copied over, and this kind of explosion of activity on this blockchain. And I think the interesting thing is there's a new smart chain, there's a new blockchain called Smart BCH. And it's basically built on top of the Bitcoin Cash network. And instead of the validator being handpicked by some central organization, the validators are based on your proof of work hash rate on the Bitcoin Cash network. So this is a decentralized network. It's the same hashing algorithm as the Bitcoin network. It's the same network of miners, effectively, as the Bitcoin network, which is an extremely decentralized network. And as a result, it has very similar attributes to Binance Smart Chain. It's a very low fee transaction network. That was one of the advantages of BSC versus Ethereum, is that Ethereum had very high fees during this period of DeFi activity, and BSC had very low fees. Smart BCH, I think, is very interesting. It has all the low fee advantages, all the EVM advantages, but it's also decentralized. And so I think that's probably going to be the winning combination. It's like, every possible advantage you could think of other than the network effect of Ethereum's applications themselves, and the assets on Ethereum itself. So it'll be interesting to see whether people prefer cheap fees and decentralized or prefer the actual asset and application network effects of Ethereum, but I think that's a pretty strong contender.
Going back to Ethereum, right? When you think about Ethereum 2.0, the world is watching Ethereum 2.0 come out. How do you think Ethereum 2.0 is going to impact the world of decentralized finance?
Yeah, so I've known Vitalik from before Ethereum, back when he started Bitcoin Magazine. And that company was at one point registered in my apartment. But Ethereum story. Yeah, it's a long story, but strange. But Ethereum 2.0 at one point was conceptualized when you basically one single update, and it would have a number of things in it. It would have sharding, which is actually a way to scale blockchain. Sharding, I think, is probably the one that's furthest along, and it's been sort of something that's been promised for 6 years now. We'll see if that ever happens. It was also going to have proof of stake, and then there's this other new improvement that's, I think, going live very soon. These sets of improvements got split up, so now it's no longer one update with everything, but it's sort of a phased 2.0 approach. And so the one that's coming up the soonest is called EIP 1559. Not a very aesthetic name, but a really powerful idea. EIP stands for Ethereum Improvement Proposal. And it's a proposal to take the fees paid to Ethereum miners and instead of for transactions, and instead of paying them to Ethereum miners, they're burning them. So this is very interesting because Ethereum is an inflationary currency. Unlike Bitcoin, which has a limit of 21 million Bitcoin that will ever exist, there will be inflation in Ethereum forever.
Because the supply is not fixed.
Because the supply is not fixed. Now, the inflation rate goes down because every year, effectively, the supply stays the same, and the base is bigger. So the new supply units stay the same. So the rate kind of goes down forever, but the supply grows. In 300 years, the supply is still going to be growing. And this is something that Bitcoin proponents critique about Ethereum. There's an unlimited supply of Ethereum, and they're right. Now, the interesting thing about EIP 1559 is because you're burning transaction fees and you're destroying them from the supply, Ethereum may go from being inflationary to being deflationary, where every year there's inflation and then there's fees, and when you take the inflation and subtract the fees that are burned, the new supply at the end of the year is actually less than the supply at the beginning of the year, which has a lot of implications for the lending as well. Well, it mostly has implications for price. So people have said that EIP 1559 is not technical at all. There's no sort of utility or technological benefits to it other than just purely pumping the price of Ethereum. And I think that's generally a valid critique. Of course, if you own Ethereum, it's not really a critique. It's like, great. But effectively, it's a change to the monetary policy of Ethereum, where it becomes that you can even maybe start to value it in price earnings ratios. You can say, okay, all these fees, you assign some multiple to it and value it almost like you value a business. But also, if you have a currency that becomes deflationary, it becomes very attractive to hold it. So I think that has a lot of implications, most of which are mimetic, effectively. In crypto, the power of memes, the power of ideas, the power of people's thoughts getting viral and infected in other people is really strong. So 1559 is an idea that's kind of captivated the investor base. Will it bring everything that it promised in terms of growth of the price? Who knows? But it's rare, and that most Ethereum development is purely focused on utility. This one is clearly focused on basically making it more of an investable asset. But then maybe we could just go further. Right? The correlation still seems a little murky. If you have a monetary supply that makes traditional financial institutions, central banks, right, supply of tokens, supply of derivatives growing, or internet pricing, how does that impact lending? Sorry, how does that impact lending? Well, I think how does that impact? Like theoretically, if you're lending something out and then that thing goes up in value, it does become harder to pay it back. So anyone who's borrowing ETH to fund some kind of business activity is short, and they have to realize that they're short if they're borrowing. And we had this problem very early on in Bitcoin history, where there was a bunch of lending businesses that spun up very early and immature lending businesses that would allow people to lend out Bitcoin unsecured to other people on the internet. And then when the price went up, those businesses all went under because those people were effectively short Bitcoin, using the proceeds of those Bitcoin to run businesses, but they didn't have the Bitcoin anymore, so they couldn't pay it back. And so I think it's the same with Ethereum and any asset that's going up. If someone's a borrower, they have to be careful. They have to realize they have a liability. And the good thing now, I think, is the market's matured on both sides, so the borrowers really know what they're doing now. But the other thing that's powerful is if they don't know what they're doing, they're just going to get liquidated. So even an immature borrowing market is not a problem for lenders in a world where there's collateral and there's smart contracts managing liquidations. So then, last question on that, and it kind of segues into our next question. What are the implications then for those who are holding Ether for governance versus for trading in speculative reasons with this new protocol? Yeah, so theoretically, most of the projects on Ethereum have some sort of governance token. I think there are still questions about how is Ethereum actually governed itself. This is sort of a hard one to answer because it's kind of decentralized, there's no process to it, really meant to be governed, isn't it? Yeah, it's not meant to be governed. If they lay out a formal process, it would be something that get attacked. But the thing that's again, part of 2.0 is starting, another part of it is proof of stake. So proof of stake is really interesting because the main way blockchains have created new units of them is been proof of work. Bitcoin, it's mined. And so people are running machines. It had been mostly in China, and now it's mostly in other parts of the world, that produce numbers, and some of those numbers are the keys to creating new units of Bitcoin. Same thing with Ethereum. Ethereum is moving away from this model to say, rather than people with electricity getting the new Ethereum, we're going to give the new Ethereum to people that hold existing Ethereum. And this is there's a lot of debate. Stu, my co-founder, has written a great article about proof of stake versus proof of work. There's a lot of debate about this concept for the last 10 years. The downsides to proof of stake are that effectively it's the rich get richer. So if you hold these, you get more ETH, but if you don't have ETH, then you don't get any of the new supply. Downsides of proof of work are environmentalism. If you have electricity as the key ingredient to produce new units of something, when the units of that thing become very valuable, people spend billions and tens of billions of dollars a year on burning electricity. And theoretically, this has a very disastrous environmental impact, which many people say is the reason why Bitcoin sucks. I don't Elon Musk. Yeah, Elon Musk is a large holder of Bitcoin, but he has stopped accepting it because of this reason. Now, I would also say that the banking system and any other financial system also spends a lot of electricity to keep lights on in large buildings with thousands of employees. So I think it's kind of either burn electricity or here or you burn it there. But Ethereum is most likely moving to proof of stake, and we don't know when that'll happen, but theoretically it's very soon. And that will have implications for lending as well, because right now you can lend out your Ethereum, and effectively the people that are borrowing it are borrowing it for financial reasons. This kind of staking model will give Ether a basic yield that doesn't involve any lending. You'll be able to stake your Ethereum on the network, and the network will pay you inflation. And so that will give it an alternative yield rate to lending out in any market. So it should definitely drive up interest rates for borrowing Ethereum.
Do you know what that rate would look like compared to possibly putting your money in your bank at a traditional interest rate?
I don't, but the difference on Ethereum and lending out Ethereum versus money in the bank is you're not only subject to the interest rate, but you're also subject to the Ethereum price going up and down. So it probably will be much higher than the bank rate. I don't know what the rate will be, but I'm sure that's actually probably figure outable, but it'll also depend on how many other people are also staking. So it'll be some variable rate, but you'll also be exposed to the price of Ethereum as well. So it's not exactly an alternative to a bank account savings rate.
Are there other utilities for these tokens outside of governance or spending trading? Any other applications? Other use cases from funds
Specifically for the governance tokens or
outside of governance and trading?
I don't think so.
Quick on the energy. So, because Elon was this tweet out, kind of crashed the market a little bit, and the whole point was Ether 2.0 is going to solve the energy crisis, and Tesla, an energy company, is going to start accepting Bitcoin again. The staking is going to increase the energy consumption. And the whole thesis was they're going to be more efficient with energy.
Yeah, so it destroys the energy consumptions entirely. So proof of stake theoretically solves Elon's problem. Elon's worried about how Bitcoin is super destructive to the environment. Well, if Ethereum does successfully migrate to proof of stake, and I say it does successfully because it's definitely not guaranteed, but if they do migrate their consensus algorithm, the algorithm that determines one, what block is valid, and two, who gets the new units of inflation that generate Ethereum, they will have wiped out the entire industry of electricity destroying miners, which I'm all for. Personally, I fall definitely on the proof of work side of the debate, but they will have wiped out that whole industry and replaced it with holders being the ones who get inflation and, get to choose who gets the block, and get to enforce the rules effectively. So that change will be very fundamental. For someone like Elon or for someone like who has environmental concerns, it will make Ethereum a way more attractive asset compared to Bitcoin and a number of other assets. There are downsides to it, but the environmental side is clearly an upside for something like Ethereum and State. I get a little wrapping on here, so just quick, maybe a couple of minutes on regulation and then a few minutes on CoinFLEX as well. One of the questions asked was your predictions on the Fed's action against stablecoin, centralized coins, algo-based stablecoins in the next few months. I think the algorithmic-based there's a type of stablecoin which seemed like an interesting idea at first. It seemed like it could work. Basically, this algorithmic stablecoin, very interesting game theory and financial experiment. Again, the powerful thing about crypto is it allows them to experiment in all sorts of crazy ways. So this stablecoin says, if the price of the coin, as measured by these decentralized exchanges, is above $1, everyone gets more units of it. So we're going to inflate the supply until it goes below $1. And the higher it goes above $1, the more units everyone gets, right? So, and then if it goes below $1, the opposite happens. So if it goes to 50 cents and you hold 100 units of it, $50 worth, the next day you might only hold 90 units of it. So until it goes back above $1. And the first one to do this was called Ampleforth, and there was a number of them that followed. And it was really interesting because Ampleforth at one point went close to $2. And when it was $1.50 or close to $2, everyone had something that had been going up, but also they were getting more of it every day. So if you were a holder Ampleforth, you made a ton of money. But the problem is when it goes to 50 cents and you bought it at $1.50, you held on to something that had gone down a lot, and then you started getting less of it every day. So it became really terrifying for people. And so, and this mechanism for trying to track $1 turned out to be a really terrible mechanism. So a lot of these algorithmic stablecoins have completely collapsed entirely. I don't think the Fed needs to worry about those stablecoins at all because they effectively obliterated themselves. The stablecoins that the Fed is interested in is Tether, USDC, and many others that have effectively become some of the biggest holders of commercial paper and other types of fixed income securities and kind of traditional financial products. So these stablecoins are extremely powerful because they allow you as a crypto user to send the dollar instrument over the blockchain to anyone in the world instantly for free. Just grab a wallet, receive some Tether, and send it to anyone else in the world, and there's very low cost. There's pros and cons for central banks. If you are the Fed, it's a proliferation of dollar dominance. So if you're the Fed, you are interested in dollars being the dominant currency that trade is conducted in. Tether and other stablecoins are now a large part of global trade between countries. They're now being used outside of crypto entirely just for settlements between multinational corporations. And so, just from that perspective, it's good. It's something that promotes the dollar, promotes the proliferation of the dollar, and expands the U.S.'s influence as a monetary thing. From another perspective, it's a scary instrument because it's a bunch of dollars that exist outside the banking system. Now they're all backed by assets that are within the banking system, but they're traded on the blockchain outside of that banking system. So I think the Fed has this and other central banks have this very interesting choice that they're going to make between do they like the proliferation that this gives them of their currency? The fact that this advances their dominance over global trade, or are they scared of the fact that all these synthetic dollars are moving outside of the banking system and maybe outside of their control or their direct control, at least? So I think that's the interesting dilemma they have, and they already do regulate these things. They are mostly regulated by the U.S. government for money laundering reasons. But the question is, will they expand the scope of the regulatory nature of these currencies to make it less transferable? And I think that's that's probably one of the most interesting questions for crypto in the next 5 years, because at this point, stable coins have become a really, really crucial part of the crypto economy. So if they do decide that they want to crack down on the transferability of these synthetic dollars, it will completely change the face of crypto in a way that almost everyone in crypto that's building a business today cannot possibly imagine. I think people are very worried about whether these stablecoins are backed. In most cases, they're very, very well backed by large amounts of assets, fully backed. So that's an overblown concern. The real problem is if they do crack down on the transferability, it will make building businesses in crypto substantially harder. So I think that's one of the most interesting questions. I don't have the answer. I'm not, someone within the Fed or these large governments, but I think those are the two things that they'll have to weigh, and we'll see. It's extremely fascinating, extremely relevant to prices of every cryptocurrency out there.
Fantastic. Well, last question for me, and then we'll open up for networking in the latter half of the evening. So, how scalable are the products by your company, CoinFLEX, like Flex USD, and how about those that are being substantially large amounts of money being invested?
Yeah, so Flex USD is providing liquidity into CoinFLEX's repo market. Our repo market has traded now, I think, close to $25 billion. It's trading at this rate almost $500 million per day. And so the minting of Flex USD is extremely scalable. You can mint really large amounts of Flex USD and you're still earning interest on it. You still might even be earning a very large amount of interest compared to even other projects within DeFi. At this point, the activities of our repo market are such that compared to Compound and Aave and these types of platforms, Flex USD holders are earning 3 to 5 times at higher rates. So it's highly scalable. The volumes in our repo book are huge. The demand for borrowing dollars and borrowing underlying is very high. And the worst case scenario is rates go down. So if someone minted $1 billion of Flex USD borrow, the rates would go down. They would still be positive rates though. Everyone would still get paid interest. So it's highly scalable, but it obviously is a free market where the more that gets minted and relative to the amount borrowed, the rates go down, and the more that's borrowed relative to the amount minted, the rates go up.
What about some of your other products?
Yeah, I mean, our other products, so our biggest and newest product is the automated market maker, and that is extremely scalable because what it does, effectively, it trades perps in the same way that automated market makers on platforms like Sushi and Uniswap work. It trades perps in this way where as prices go up, you're selling out, as prices go down, you're buying more. And that is probably even more scalable than Flex USD in that the only thing holding that back is the volatility of crypto. And as we all know, crypto is extremely volatile, and the demand to trade it globally is enormous. So Yeah, the automated market maker, I think that will grow to many billions of dollars. And as that grows, which should become a more and more liquid exchange relative to the other exchanges. It's something that no other exchange has in terms of the derivatives exchange, the centralized exchanges. And it is something that we think is very core to how we grow in the future.
Fantastic. Well, ladies and gentlemen, please help me giving a huge round of applause to Mark Lamb.